Honeywell is currently splitting into three separate companies: Advanced Materials, Aerospace, and Automation. The first was already spun off last year, while the other two parts were split on June 29. And if history is any guide, this could unlock a massive value. Just look at what happened to GE Vernova or Sandisk after their spin-offs. So why are investors eager to pay more for less, and what can Honeywell split offer for investors? As we already discussed in an earlier video, the so-called Conglomerate discount is simply spoken a stock price reduction done by investors as compensation for getting less control over exactly targeting which segments an investor invests their money in. Quick example, let's say you want to invest in General Electric, but you don't want to have an exposure to healthcare. Then you can buy GE's electric gas turbine producer, GE Vernova and GE Aerospace. But it gets even better. You can specifically decide how much of your money goes into which segment, meaning you can say 50-50 or 25-75. Investors buying stocks of a conglomerate like Honeywell, General Electric or United Technologies were given less freedom over where the money is actually invested. The investor gave the control to the company's executives, which must choose the best interests of all shareholders, whether they are just investors because of the aerospace segment or just advanced materials, or simply both. So why do companies do this in the first place? The easy marketing 101 answer is synergy effects. While running an aerospace company, it might be helpful to also be working with advanced materials. So why do not combine both? Well, that's just the perfect picture story. Most of the time, synergy effects are overestimated and in the end add unnecessary complexity to a company. So the CEO might be excellent in advanced materials, but may lack some aerospace expertise. Investors want to simply pay more for the individual parts of a company since they gain a level of freedom and flexibility. Take for instance United Technologies, which consisted of RTX, the aerospace and engine specialist, Otis, the elevator producer, and Carrier, the HVAC and cooling manufacturer. All three stocks went through the roof after splitting up, simply because the conglomerate discount on United Tech, which mixed up different segments under one roof, was set free, meaning investors gained back the flexibility. This resulted in Carrier skyrocketing over the next few years, while RTX was solid. Otis was the weakest of the three, but only Carrier outpaced the S&P 500. Additionally, today's markets are heavily driven by index funds, which includes sector ETFs, such as the largest US aerospace and defense ETF from iShares, and is exposed almost 14 to 15% in RTX. This purchase power would have not been possible because sector ETFs have strict rules to hold only assets in a specific sector. Another great example is General Electric. After it split into three dedicated stocks, each representing a main segment of the past General Electric, the healthcare segment disappointed, while the other two segments, especially GE Vernova, were popping. GE announced the split back in 2021, and in investors' imagination the best part was GE Aerospace, while GE Vernova was supposed to be the runt of the General Electric breakup later. Instead, it now has a larger market cap than GE Aerospace. Why? Simply because artificial intelligence needs four magic ingredients: powerful GPUs, memory chips, cooling, and a lot of electricity. The latter is delivered by GE Vernova's wind systems, turbines for nuclear and gas power plants. While GE Aerospace was pushed by the defense theme and roughly two-folded, GE Vernova stock more than six-folded since April 2024, as both stocks started to trade separately. We often emphasize the importance of small caps, and the next example is Sandisk, which was spun off from Western Digital, which bought Sandisk back in 2016 and now wanted to split it again. So why the split again after less than 10 years as a conglomerate? At first glance, this doesn't make sense, especially considering Western Digital makes memory chips and Sandisk does the same. So this should be a no-brainer when it comes to synergetic effects, right? Well, in reality, it was more complex, as Western Digital produces classic hard disk drives, which are still heavily used for large data centers, even though they are slower than flash memory, but the longevity of hard drives is way higher. Sandisk, on the other hand, produces mainly flash memory, which is used heavily for end customers, alike for data centers. The key difference is that both products, even though targeting the same result, storing data, the production process quite frankly differs a lot, and thus it makes strategic sense for them to split. In April 2025, Sandisk was spun off from Western Digital, and just 7 months later, Sandisk moved from the small cap index S&P 600 to the large cap index S&P 500, because the demand for memory outpaced the supply as the AI data center boom kicked in. Honeywell might still have to prove if it has the same potential to be unlocked. But the advanced materials segment, which was already spun off into Solstice last October, was already a good sign, as it already gained 71% since the first day of trading as an independent stock. So what will all three separate stocks of Honeywell consist of? First, Solstice, which is active in three main segments: refrigerants for food retail and data center cooling, thermal material for semiconductors to reduce heat, and nuclear energy, while Solstice is the only US domestic uranium hexafluoride conversion facility. To understand why this is so special, you need to know that before a nuclear power plant can use uranium, the raw uranium ore undergoes 4 steps: mining, conversion, enrichment, and fabrication. And the conversion process can only be done in the US by Solstice, which uses the chemical processed raw uranium called yellowcake to convert it to a gas called uranium hexafluoride, which is then used in the enrichment process. As energy demand is high at the moment because of AI's massive electricity usage, so is Solstice conversion expertise letting its stock soar. The second stock will be Honeywell's automation segment, which consists of smart building systems, refinery and petrochemical automation, and robotics. So it's seen as the runt of all three Honeywell stocks. But Honeywell's stake in Quantinuum, a quantum computing startup, will be included in Honeywell Automation. So that's at least a treat. The automation and quantum segment will be called Honeywell Technologies and trade under the already existing HON ticker. Honeywell's jewel will be the last stock, Honeywell Aerospace, trading with the new ticker HONA, which produces aviation systems such as for radio or satellite communication, turboprop and jet engines for military and private jets such as the General Dynamics Gulfstream G280 or the Bombardier's Challenger 3500. Additionally, they are heavily into the APU business, which is the small unit at the back of an airplane called Auxiliary Power Unit, responsible for power and fresh air within the cabin during the flight. As we pointed out in our video about Airbus, the A350 is a hot-selling airplane, and the A350 is rocking Honeywell's HGT 1700 Auxiliary Power Unit. But that's not all. Boeing and Embraer are also among Honeywell Aerospace's most important customers. For example, the Boeing 77X or the Embraer 195 is equipped with an APU from Honeywell as well. The aerospace segment generated $17.5 billion, which is an organic increase of 12% year over year, with profit margins hovering at around 24.5%. But these profits are before interest, taxes, and depreciation, and thus should be taken with a grain of salt. Within the 10K form of 2025 or the Aerospace Investors Day presentation, one cannot find the net earnings of the segment. And that's exactly what we have to find out once the aerospace stock starts trading on June 30. Additionally, it is worth looking at the Invesco S&P spin-off ETF, which is composed of US companies that have been spun off from larger corporations within the past 4 years. Since the ETF started trading in 2006, it returned 466%, crossing the S&P 500 multiple times in the past, which returned 421% within the same time frame. While its top 3 holdings are Sandisk, GE Healthcare, and Solstice. Honeywell Technologies, as well as Honeywell Aerospace, will probably following soon once they start trading as independent stocks. If you find this video interesting, make sure to subscribe. Thanks and see you in the next video.